Within this presentation, we will look at the options available for providing an income in retirement and discuss the advantages and drawbacks of each approach. The options for providing an income in retirement are vast, with pension savings being one of the options available, however the most typical. Generally, the options available all target the accrual of capital which would, in one way or another, be used to provide an income in retirement. Instead of, or alongside, saving into a pension, you could consider the use of investments, for instance, stocks and shares ISAs, collective investments, or directly held shares. Cash savings also provide another method of accruing capital amount, and again can be saved into an ISA. Property also provides the ability to generate an income in retirement, whether it be the rental income from a buy-to-let arrangement, or downsizing from the family home and providing an appropriate arrangement for the proceeds. Both would be expected to provide income from capital. Of course, each route has advantages, drawbacks and risks. While we will be delighted to discuss these with you on a one-to-one basis, this presentation will provide an overview of saving into a pension. In general terms, a pension is a form of investment which provides tax efficiency at the expense of accessibility. While there are different types of pensions, the benefits of pension savings are similar independent of pension type. Tax-efficient contributions. In general terms, when you save into a pension, the money saved are considered as deferred income. By the nature of this deferment, you would receive tax relief on your contributions, with these contributions often referred to as gross payments. As a result of this, when monies are eventually drawn from the pension, this will be regarded as income and potentially subject to income tax. This said, under current rules, it is possible to draw a lump sum from the pension when retirement benefits are taken, with the level of lump sum varying from pension type to type, however being payable without any liability to income tax. Tax-efficient growth. Should your pension invest the monies contributed on your behalf, with a number of small exceptions, the growth received would not be subject to tax. As a result, the compounded effect of the gross contributions and tax-efficient growth can have a significant advantage over time. Contributions from different sources. As a result of government initiatives and the introduction of compulsory workplace pension schemes, it will be likely that your employer, if applicable, would contribute to a pension on your behalf, increasing the level of pension savings without an increase of contribution. For more information relating to the workplace pension changes, please see our presentation on this subject. The maximum level of contribution to a pension is also limited by legislation, and we have prepared a presentation based on the annual and lifetime allowance for further details in this regard. Restrictions on access. While the tax advantages of pension savings make the option a very attractive one, there are restrictions for access to pension savings as a result of this. These restrictions have been set by legislation and therefore may change in the future. At present, however, it is not possible to access pension savings in an authorised manner prior to the age of 55, with the age set to increase to be 10 years below your state retirement age in the future, commencing from 2028. Subject to changes. As with all aspects of life, pension legislation has been subject to many changes over the years. There would be no reason to consider that these changes wouldn't continue, and given the typically very long term during which pension savings are completed, the potential for change is always something to be aware of. Now we have provided an overview of the merits of pension savings, we would like to discuss the differences between the two main types of pensions. There are a number of different types of pension, however we would like to provide an overview of the two main types of pension savings: defined benefit, otherwise known as final salary, or defined contribution, otherwise known as money purchase. For defined benefit or final salary pension schemes, benefits within the pension are accrued as a proportion, for example 1/80th per year, of the final salary, or in some cases the average salary. Benefits are then paid from the plan upon retirement, subject to the scheme rules, which may include specified benefits for a spouse or civil partner, indexation, or the option to reduce the annual income for a lump sum payment at commencement. Given the nature of the accrual of benefits, the level of income received from this type of pension is independent of investment market returns, with the trustees of the plan bearing the responsibility for ensuring the pension scheme can meet its obligations and liabilities. The other main type of pension, defined contribution or money purchase, operates in a different manner. With these schemes, your monthly payments to the plan are invested with the view that, over time, investment returns would provide growth and assist in generating a pension value at retirement. As investment returns are, typically, not guaranteed, the eventual level of pension fund cannot be determined at the start of the pension. However, it is usually possible to specify an investment strategy and subsequent level of risk for any investment completed. Upon retirement, the decisions on how to generate an income from the plan would rest with the individual, with a number of options available which are governed by legislation and market forces at the time of access. Given the choices and the options available, the contents of this website are aimed at individuals who have accrued benefits within defined contribution or money purchase pensions, as defined benefit or final salary schemes would provide a different selection of options which are much more prescriptive. We hope you found the information contained within this presentation of use. The contents of this presentation are intended to provide information only and not financial advice. Please feel free to contact us if you would like to arrange a meeting to discuss your objectives and requirements further. Our website, www.norfolkandsuffolk.co.uk, contains our contact details and further information about our services.